Good morning and happy Tuesday. Welcome to another morning live with Real Estate Mindset and our community. You guys know how much I love doing these lives. It's a great way to give back to the community for us to grow together and just to keep our pulse on the housing market on a real time basis. So I'm really looking forward to this, guys. It's been about 2 weeks, so I'm not even sure if I remember how to do it. I feel like naked right now because it's been so long, but I did get back from the road trip. You guys should know I took a road trip to Dallas, San Antonio, and Austin, and it was such hard work. I can't tell you guys how hard of work that was. I mean, I almost had heat stroke. You guys know how hot it is in Texas and hauling equipment downtown? I mean, that's scary. And there's people like looking at me. Are they going to take it? Either way, I'm so happy to be back. I really hope you guys are liking those videos. New style completely. Comment if you guys can below. Let me know if you guys like that style because it's a lot harder work. And honestly, okay, I lose money. We don't make money on those videos. Neither Melody nor I make money on those videos, but I love them. I love them, so I can only do a couple here and there, but I love them. I wish I could afford to do those all the time. Let me know if you liked them, though. Also, guys, I may have to postpone our Friday morning live. I may have to do that on Saturday because I have a final walkthrough I have to do with a client. And I want to be with them every step of the way. And I may do an interview with them and ask them questions like, why didn't you wait? You know, things of that nature and report back to you guys. So look out for that. It's probably going to be Saturday. Also, another thing, guys, what I'm going to do on this live, we're going to do trivia. All right, we're going to do another round of trivia. It's going to be the realtors versus the real estate mindset community. So I want to make sure, though, that there are realtors online. If there are any realtors online, please make some comments in the comment section below so I can throw those up on the screen to make sure that we have enough realtors. Remember, guys, the last trivia that we did, y'all smoked the realtors. But remember, there's not as many realtors probably watching as real estate mindset community. But if, again, I'm serious, guys, I want some realtors to step up. I'm gunning for you, realtors. Like, I'm on your side now, okay, just in this video because we can't have you guys get swept. I need some realtors to start doing some like really cool stuff. So again, guys, comment below. Where are the realtors at? Oh my gosh, what's up, Julian? This is my boy. This is my boy. Him and I go shark fishing all over the place. This guy right here, you guys see this guy? This is the guy. This is why I broke my ribs. You see this little punk right here? Me and him were wrestling. I didn't even want to tell you guys this. Me and him were wrestling. I broke my ribs. I body slammed him, choked him out at the cost of breaking my ribs. You guys, I'm 40. This dude, I mean, Julian, you're 28 working out every single day. I love you, brother. I'm glad you're here. I want more realtors. Where's the realtors? Okay, here's a realtor. Okay, good. Raymond, you wish, brother. All right, so just keep coming online, realtors. I have some trivia. Now, before I jump into the mortgage update, I want to basically kind of respond to a question and a comment that I get. So I did a video yesterday. I did the Redfin video yesterday, and I made a comment that, hey, if you're going to still buy, at least purchase homes for under market value so that you help bring down the prices of houses, right? In other words, don't just go out there, use your emotions, and keep driving prices up. And someone made a comment because they misunderstood what I said. They said, Travis, why are you saying to buy now? And so I wanted to, I wanted to confront that because I don't want anyone to get stuck in a narrative. I don't want anyone to get stuck on the sidelines being content and expecting a headline to tell us when it's time to buy a house, okay? So we really need to talk about that, guys, because the fact of the matter is have I said it's okay to buy right now? Yes, under certain conditions, a massive long laundry list. It's like, boom, boom, if you do all these things, then okay, fine, and you can't wait, then buy, right? The thing is what I said is if you can't wait, like that's a pretty big thing to remember, guys. I'm saying if you can't wait. Obviously, I think we should wait for recession, wait for after the election. But there's different levels of affordability. We're going to go into affordability calculator today so I can show you, and that's to Jeff's point he made the other day. But the thing is, guys, you have to ask yourself, what do you want? What's a housing crash to you? The definition of a housing crash varies significantly. Some people think it has to go back down to pre-pandemic. I don't think that. I have said my baseline for a crash, the start of a crash is 15%. We did not hit that on a nationwide average for existing. We did hit that for new homes. New homes existing, two different markets. Jeff M's market, he's probably still got bidding wars. Places in my market, I'm finding abandoned new home communities, which reminds me, take a look at the sign behind me. You guys see the sign? If anyone knows the contact information to Mid-City Homes, just let them know I have their sign. Back there, I found that outside of the abandoned community, so I did not take it off the property. But I'm desperately looking for mid homes. I want to contact them to give them their sign back, but I just can't find their phone number. Everything I found is disconnected. But I just want you to know, you guys know where they are, how to contact them. Let me know so I can give them their sign back. Abandoned community. Abandoned. You guys, it's crazy. Things are crazy right now. But anyways, different markets. So back to what I'm saying. You have to ask yourself, what do you want? Do you want to buy a home at 2021 prices, 2020 prices? Do you just need incentives, cash flow, wedge? What do you want? So that's where I want to start by really acknowledging that question. And I wanted to bring this up, guys. This is the median sales price for all homes sold. This includes existing and this includes new. So right now, guys, when we add both of those together, look at the big picture, we're sitting at about 417.7. Okay. And I circled this right here. Oops, sorry. I circled this right here because I just wanted to point out that the median sales price on average is actually lower when we count all this stuff, new homes and existing, is actually lower than Q1 of 2022. So that's why I'm saying, hey, did anyone know? Raise your hand if you knew that, right? That's what I'm saying. Don't get lost in narrative, guys. You have to understand your market. Can you find a house right now at 2021 value? Okay, which is right here. Okay, can you find a house right now at 2021 value? I can in my market. And that's why I'm saying, guys, I can find a 2021 value, but even then it's probably still best to wait, especially if you're overextended, because I believe we're going to have even more price declines and that will spread. But right now I'm finding diamonds in the rough. And so when I purchase, guys, or when I'm looking at homes myself, I'm using my base as 2021. Okay, so I'm basing whether or not I have a good deal based on price points right here. Now, understand, I can do that in my market. I'm in Texas. Jeff M can't do that. Okay, Todd Sachs in Maryland, he does a little bit more high price point. He can't do that. They're both dealing with bidding wars, but I can do that because I have a market with massive amounts of hyper supply, specifically with new builds. Plus, also the investor demand is kind of curving. But anyways, guys, we're already at the beginning of 2022 values on average. You have to understand this. So again, just going back to, what am I saying to people? Okay, so I'm using 2021 values, first of all, and I'm also explaining to people, I'm trying to explain to people, and I don't want people to get this wrong about what I'm saying, okay? You got to have the proper expectations. Having the proper expectations may be the biggest thing of all. Like, what's the proper expectations? You got to hold for 10 years. Just have that expectation. If you got to hold 10 years, you're comfortable with that, see ya, right? But still be safe. But, proper expectations, 6 months of savings. I see this happen all the time. You don't want to purchase a house and not have any money left over for any types of emergencies. And also a lot of times you got to feel that house. Emergencies like air conditioning, foundation, roof, water leaks. You can't go broke. You shouldn't. You can buy a house going broke. But what I'm saying is you shouldn't. You should prepare. You should be strong moving in. So again, 6 months of reserves, no consumer debt. Right? No consumer debt. If you can't handle your credit cards, why do you think you can handle buying a house through a recession? If you can't control your spending habits on your credit cards, what makes you think you can control and get through a recession purchasing a house? I'm not talking about anyone that bought before 2022. I'm talking about new home buyers. I'm talking about home buyers on the sideline that are struggling to stay on the sideline. I mean, no consumer debt. And I've changed this a little bit, 30% of your income going towards your mortgage. So 30%. Also, guys, wedge, cash flow. And here's the biggest thing of all, probably the right market. The thing is, guys, is like I can be more optimistic in my housing market. Jeff can't, Todd can't. The different markets, different things are happening. But always remember, you guys, and we're going to go into this a lot during this video, subdivision analysis. Everything that we talk about, everything is macro. I don't care if it's talking about city, zip codes, it's still macro. If you guys want to get local, you want to get micro, subdivision. If you're in a rural area, then you got to go like 2 miles, 5 miles, just depends how many comps there are. Now, one more thing, guys, but I hope that makes sense. I hope I explained that well. And the fact of the matter is that list that I just gave you, it's almost impossible to hit. It's almost impossible to hit that. But as prices adjust and correct, again, it just depends on your market. You'll find more deals like that. Now, thing is, before I get to mortgage update, we have a Discord. I hope you guys are part of the Discord. Some crazy stuff, conversations in there. I try to participate as much as possible, but I'm going to tell you guys right now, one of the things that motivates me as a content creator that gets overwhelmed and wears my heart on my sleeve, the community. You guys, the community in Discord is so uplifting to me, especially to me. There's a little bit of pettiness. Mr. Watson's not online. There's a little bit of pettiness, but dude, people in Discord are making people stronger. And so I would suggest that. Now we have a Discord question. That's what I'm getting to. So we had a question by Trey. Trey's one of the creators of Discord. I don't know if he's on. I really love Trey. I look at Trey as my buddy. Trey to me is like, he's like, Trey represents to me the first time home buyer in America. And so when I talk about Trey, the member of our community, I look at him as just this precious, he's just precious. He's precious, and I need him to succeed, and I need him to win. And I'm scared, you guys, because I think he just made 2 offers this weekend. But thank God he's making offers based on that laundry list I just gave you. Before I even like went into him, he's like, Travis, don't worry, wedge, cash flow, blah, 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 blah. I'm like, fine, Trey. But I'm nervous because you represent, to me, you represent America, Trey. And I want good things for you, brother. So his question is, why sometimes on MLS does it show homes pending for so long, or like option pending, under contract? Why does that take so long sometimes? Now, usually, Trey, there's a lot of answers here, so I'm going to generalize this question. I'm going to generalize these answers to the question. Generally, it's not good. If it's up and pending for a long time, the 3 main things, they're negotiating back and forth still, so it's still more negotiations. Second thing is inspections. So something came up on the inspections, maybe mold, and they have to do remediation, maybe a crack in a pipe. So you have negotiations, you have inspections, and another big thing, brother, the loan. A lot of times you're going to see transactions stall and take longer if the buyer is struggling to get their financing together. And that happens all the time. And that's why I'm always telling you guys, make sure your money is in order before going out. Because again, like if you get your finances together when you're already in the middle of the transaction, you guys can lose your earnest money. You don't want to lose your earnest money. You want to be a strong buyer moving forward. So I hope that answers that. We're going to dig right in now to our mortgage update. That was a 12 minutes for me to get to the mortgage update. Oh my gosh, you guys, this is crazy. Things just changed. Let me set this up real quick for you. Take a look at this. This is insane. Look at this drop. This is a massive drop right now. I don't know. Something came out. Something just came out. This is the 10-year. We track the 10-year Treasury. You guys, the 10-year Treasury tracks mortgage interest rates. This was up all morning. This was in the this is almost at 4.65. I mean, look at guys. And then just all of a sudden, I don't know if you guys know, in the last 7 minutes, you guys, this has plummeted. Look at this. Look at the trajectory. What happened? PMI came out. PMI came out soft, probably PMI came out soft, and it's dropping that. Remember it was about a few Mondays ago, PMI came out and it came out hot. It shot the 10-year up. That surprised a lot of people. That's crazy. 10 years going down. So what's going to happen, guys, is more than likely later today, this will drop residential mortgage rates. Just depends what happened, but that is a huge volatility in the 10-year right now. Huge volatility. That's crazy. Anyways, guys, let's look at today's mortgage interest rates on average. So I go to Mortgage News Daily. A few things I want to point out. Average mortgage rates for conventional is sitting at 7.43%. This is good. Thank God we have this. We need higher interest rates because we need to tamper down the home buying demand through the spring housing market season, because we need inventory sustained. We need that sustained, right? So anyways, we're sitting at 7.43. But if that's what you're getting, you're not listening to me, because I'm telling you guys to shop your mortgage. You can get lower than this. You can get lower than this. Shop your mortgage. Generally, a broker is going to be cheaper, okay, than a direct lender. But I also want to point out the 30-year on FHA. The 30-year on FHA is over 50 basis points lower than conventional. But the interesting thing is it's now higher than 15-year. So usually if FHA is lower than 15-year, it's higher now, and FHA is slightly lower than VA as well. Okay, so very, very interesting to see those changes right there. Now let's move on. Let me show you guys CME Fed Watch. Now this is the market's anticipation on what's going to happen next to interest rates. This is freaking crazy. Now people are saying, yeah, they're going to cut rates, but no one is saying they're going to cut rates, because most people are not saying they're going to cut rates because of economic turmoil. Right? You cut rates to stimulate. I keep trying to say that to people. Now, and I'm going to show you guys something nuts, okay, that just happened. But anyways, this is December. This is the end of the year. The market is now pricing in a roughly 16% chance of no rate cut in 2024. Do y'all remember the video I made a couple months ago saying no rate cuts unless there's economic turmoil? Do y'all remember the video I did in December with Jason Walters saying that basically we'd be in the situation we're on now? If we don't have economic turmoil, if we don't have any type of collapse, why would they cut rates? Why would they cut rates? They're not going to cut rates, you guys. Anyways, 15.9% likelihood according to the market, who never gets this right. Now, look at this. I just for kicks and giggles, I went all the way to September of 2025. Okay. So I went to September. This is a year and a half. The market doesn't know what's going on. Let me show you guys. So I went to September 2025 and they're still pricing in no rate cut at 1.7%. To me, this is showing the market doesn't know what to do. The market's emotional. The market's always going to be optimistic. And now that the market's saying no recession, nothing bad's going to happen, keep spending your money, things are going to crash. That's what I honestly still think they're going to cut rates this year because I think something is going to crash in our economy. Again, that depends on deficit spending and propping up. But you guys look at that. September, you see here, September 2025, 1.7% likelihood, no rate cut. And look at this, guys. The highest likelihood is right here, 3 rate cuts by September 2025. So much for the whole date the rate and marry, your mortgage payment forever because you can't refinance, right? And that, my friends, is why you do not purchase real estate with an expectation to refinance. Now, I know investors do that. I'm not talking to investors. I'm talking to first-time home buyers. Now, moving on, guys. Let's see. What do we want to cover now? I want to go over the amortization schedule as well. And then I'm going to have some trivia. So again, I want to see realtors. The trivia is going to start here in a couple minutes. Okay, here's your amortization schedule, you guys. This is a beast. This is why I hate when people say, just refinance if rates go down. Yes, I get it. Refinance if rates go down, but look at the amortization schedule. You guys, for a loan amount of $324,000, when we take an interest rate of 7.43%, total amount of interest you pay back on a $324,000 loan is $485,000 in just interest. When I divide that back into the original loan amount, that means the interest you would pay at 7.43% over 30 years is 150%. But most of that 150% is paid in the first 10 years. So you pay the 150% before you pay the principal. I just want everyone to know that. So it's actually more than 150% if you look at the trajectory and speed of which you pay interest, but regardless, 150%. So I say that all the time because we get shamed. Oh, you're making your landlord rich. Well, pick what you want. You want to make the bank rich. You want to make your landlord rich. As long as you have a happy life, you're loving your children, you're loving your family, your relationships are strong. Who cares what people say? Now, I want to show you guys this as well. Okay, this is how you combat these amortization schedule. After you close, you can always pay down more money towards your principal. In fact, I highlighted 306, 346 because this says if we pay down our principal directly by $17,654, which is your own money, you get the money back. You're not even paying a fee. You're just putting your money, paying your principal down. You get that money back if you sell. It's your money. You guys, it's your money. It's not a fee. So you pay $17,654 down on your principal. You save these first 5 years. You see this in this column right here? Each row represents how much interest you pay per year. You guys save $115,000. And it's the $17,000 is your money. I'm just saying, if you guys understand, even if you don't do this, if you understand an amortization schedule, you guys are ahead of 90% of consumers. Just understand, please, guys, understand how this works. Now, what I want to do is I want to get to the affordability. I want to show you guys affordability. But before I do that, we're going to go for some trivia. Okay. And I want to see some realtors. Okay. I want to see some realtors get this right. We're going to go in for our first trivia. Here's the question. Comment below. I already know REM members. I already know you're going to kick butt, but realtors. Okay. Just get, I need more realtors to come back to the comment section. Come back, realtors. I got a question. Don't let Real Estate Mindset members beat you. Okay. Here's our first question. And this is easy, so be ready. Be ready. How do you turn a 30-year loan into a 15-year loan without having to refinance? How do you take a 30-year loan and turn it into a 15-year loan without having to refinance? How do you do that? How do you do that, guys? Let me see. How do you do that? Okay, how do you guys do that? I'm waiting for some comments here. Johnny, you're messing me up. That was funny. All right, Nikki got it. Make extra monthly payments. That's right. You don't have to refinance to turn your loan into a 15-year loan. You don't have to refinance. All you do is you pay extra money towards principal. Nikki, that's one for Real Estate Mindset. Okay. So Nikki, if you're a realtor, let us know you're a realtor. If you're not saying you're a realtor, I'm going to assume you're not a realtor. Are you a realtor? I don't think Nikki's a realtor. So that's one for Real Estate Mindset. Good job, guys. Second question. Okay, get ready for the second question. You pay extra. Boom, boom. Okay, okay. Realtors, get ready. Okay, get ready. What is the money called? Okay, What is the money called that's involved in the real estate transaction that I'm constantly saying agents need to protect? What is the money called that consumers pay in the transaction that you need to keep safe? It's very important you keep this money safe. There it is right there. Boom. Got it. Earnest money. That's right. Your earnest money deposit. Don't forget that, you guys. You always want to keep your earnest money deposit safe. Okay. An agent should always be keeping their clients' money safe. And that's from P Nice. P Nice. Oh my gosh. No. No, not your commit. Orlando said, "What's up, Orlando? Look at this guy's amazing. I love Orlando." He said, "My commission." Oh, he's just joking. He's just joking. We got okay, so that's 2-0. Okay, we got 2 answers right by Real Estate Mindset, 0 from realtors. It's called earnest money. Third question, and then we're going to get started here again. And I need you realtors to step up. Okay, I want to see my realtors in my community. I've trained 400 realtors in Houston. I've trained 400 Houston realtors. Don't disappoint me. Question number 3. We're going to take out VA. We're taking out VA. How, you guys should know this. How do you avoid mortgage insurance? When you purchase a home, how do you avoid mortgage insurance? Minus VA. VA doesn't come with mortgage insurance. How do you avoid mortgage insurance when you're purchasing? How do you avoid it? How do you avoid it, guys? How do you avoid it? How do you avoid it? Boom. There it is. There it is. There it is. Got it. 20% down conventional. That's right. That's 3-0. Oh, I see a realtor almost got it. That's right. So it's 3-0. You guys, you put 20% down on a conventional mortgage. Remember, if you put 20% down on an FHA mortgage, you still have mortgage insurance. And that mortgage insurance lasts for 11 years. On FHA, if you put 10% down or more. But if you do conventional, 20% down, you avoid mortgage insurance. For conventional, it's called PMI, which is private mortgage insurance. For FHA, it's MIP, mortgage insurance premium. Good job, guys. Now, here's another good one, and then I'll get started. Realtors, you almost got that, realtors. You almost got that, but the Real Estate Mindset community is just fire, man. We keep each other strong. We're ready to go. We talk about these things. Props to the community. But realtors, this one's for you. Realtors, you know this answer, realtors. 2 ways. What are the generally? We're going to generalize. Generally, there's 2 ways to increase your purchase. We're going to say debt to income ratio. There's 2 ways to decrease your debt to income ratio. What are those 2 ways? How do you reduce your debt to income ratio? Debt to income ratio is like a gauge to your affordability. It's like your purchasing power, debt to income ratio. So how do you decrease your debt to income ratio? 2 ways. There's 2 ways you decrease your debt to income ratio. When your debt to income ratio is decreased, you're able to generally get, here we go. Got him. Got it. Good job, man. Wow, Nikki is on point. Good. You got another one, Nikki. That's right. You either increase income or you reduce debt. Again, if you want more purchasing power, and this is to Jeff M's point, and I'm going to go into Jeff's M point here. Jeff was like, you guys, the bigger thing is work on your spending habits. And there's your housing market crash. It's so true. It's so true. There's so many people that they can get more purchasing power. Someone said file bankruptcy. Maybe Austin, but no, the answer is more income and less debt. Very impressed. All right, so let's go into Jeff's point. Let's go into the debt point here. Now, here's what I'm doing right here, guys. And this is purchasing power. So this is an affordability calculator that you're looking at. This is important. I really want you guys to understand this. So what I've done is I put my annual household salary is $100,000. Okay. So my annual salary is $100,000. I'm doing a 30-year loan at today's mortgage interest rates. I'm saying that the total amount of debt I have is $1,000. So $1,000 in monthly debt. So I have $1,000 in monthly debt. I'm doing a 10% down payment, 1.5% property taxes. It's higher in Texas and lower than some other areas, 0.5% in insurance. And what I'm using is for the DTI. Remember, we just went over debt to income ratio. Debt to income ratio is so important. I hope you guys understand that. So I'm using a 40% debt to income ratio. You can probably, depending on the scenario, squeeze 45, but I just said you don't want to do that. You want to go at 30%. Remember I said that? But regardless, 40%. Okay, so I'm adjusting 40% debt to income ratio. I'm going to calculate. And if I make $100,000, look at this, guys. If I make $100,000, I qualify for $281,000 manufactured house in a bad neighborhood. So if I make $100,000, I'm just kidding. If I make $100,000, I qualify for about $281,000. But let me show you something. Let me show you how important debt to income ratio is. And this is what Jeff M was saying. Jeff M and I disagree with the prices of houses, but I mean, I understand his market is bidding wars. Again, my market, I'm fine. You see the sign behind, I'm finding abandoned communities. So I get it, right? No one knows exactly what's going to happen, the way it's going to happen. But when I remove this $1,000, and that's what Jeff's like, dude, just pay your debt down, pay your debt down. Watch. So I'm removing $1,000 in monthly mortgage payments, and now my purchase qualification goes from 281 to $402,000. I increased my purchasing power by $121,000, about 30%, by having no debt. Jeff, is that your point, Jeff? My man, Jeff M., that's your point, right? You guys, Jeff is not wrong in all of this. He's right. Consumer spending habits are incredibly, incredibly important. Okay, so we're going to move on, though, guys. I'm going to listen to our first video. Our first video is going to be about the first rate cuts are going to be in December. We can't trust the market, but the first video is rate cuts, first set of rate cuts coming. Maybe December. If you guys can, please let me know that the audio is okay. And we're going to start this right now.
So you said you didn't see rate cuts 2 months ago. We spoke on the 16th of February. It's now the, 18th or 19th of April. What do you see now? Same?
Oh, well, back in 2 months ago, I was really just looking at the numbers, just like many other portfolio managers and financial advisors around the country, just looking at CPE, PPI, employment rates, and we really didn't see any reason why a Fed should cut rates. And so that's why I had that thesis. I think going forward, I think one thing that you've got to really look at is November, right? We're in an election year. And it's really hard to see that Powell wants to play this kind of role of raising or lowering rates in an environment where November's the election. He doesn't want to come out looking favorable to either party. So I think it makes sense just to stay the course. And December would be the closest possible date you'd see any kind of movement from the Fed because of the election.
So what does that imply then for what I should do with my money? I mean, you have some things you like. You like the XLE, energy. You like gold, SMH, I guess that's semiconductors, big tech.
Yeah. Yeah. So listen, I think that XLE up 12.8% year to date. I think it's going to be even more of a play because of what's going on in the Middle East. If you see the Strait of Hormuz get disrupted, but it doesn't have to be Iran. It could be a number of different actors.
Could be the Houthis.
Exactly. And so if that happens,
Thank you.
You could predict anywhere for 2 to 5% increase in energy around the world. All right, that's 20% of all crude oil around the world goes through that strait. And listen, we are in a new phase between Israel and Iran in regards to what they're capable of and what they're doing. And so everyone's on edge. All my clients are wondering how this plays out. And so you're looking at to hedge, buy gold. And if you're thinking that this is going to be an ongoing issue, you got to own energy.
Would those edged customers and clients, and yourself included, would you be a little less on edge because of what has just happened overnight with Israel attacking Iran, but in what appears to be a relatively tempered way? So maybe some of that tension is dissipating just a bit.
Listen, you can grab at straws anywhere you want, but they just fired 100 missiles in Israel, and then Israel just attacked them 24 hours ago. So if you're feeling comfortable, I don't know why. And so I think that they are de-escalating verbally. I'd like to see that happen actually. And so until that happens, I think that every investor should get defensive.
So what should I do if I have some cash that I want to take out of my equity portion of my portfolio, perhaps because it's grown up against the upper bound, not because of anything I've done, but just because it's expanded so far this year, and I want to put it to work in fixed income? Where would you put it, and at what maturities?
Listen, I think that fixed income is an important part for investors who are looking for income, and they're also looking for preservation of capital, but that hasn't happened in the last 3 years in the fixed income market. So I have a lot of clients that are looking at money market rates. They're over 5% right now. Great place to hide out while you're doing that. Also with, the President Biden talking about $400,000 or more, you're going to be taxed more. A lot of folks are talking about munis now and where they can go to protect some of their hard-earned money and go into an environment, fixed income investment that'll be tax efficient, right? Yeah. You can get triple tax exemption if you're getting a muni in your state. So those are all things that clients are talking about and where they should be invested in.
So you don't expect a rate cut until at the earliest December of this year. What will it take to cause that to happen? What will the Fed need to see, and for how long?
You'd have to see some serious things happening with the employment rate. You'd have to see core CPE go way below 2.6. I mean, there's a number of different factors that we're all looking at. And right now, none of those are saying and screaming out to the Fed, they need to make a rate cut. So I think politically, which I think is obviously we always have to think about when you're thinking about the government, November is the date that they've got to wait before they make any significant decision in this election. So jury's still out, and I think November is.
You made a bold, counterintuitive call back in February, and you're doubling down.
All right, guys. So again, you know, I see some people get this right. I see some people get this wrong, but you know, just keep asking yourself this question: why would they cut interest rates? I mean, the Fed has been pretty clear they need inflation down, right? We need price stability, right? So why would they cut interest rates? Because remember, guys, cutting interest, and I know the servicing the debt, but we've looked at historical data. That, I mean, there's some point and validity to servicing the debt. But if they cut rates to stimulate the economy, and they would be stimulating the economy when we have runaway inflation in some markets. So again, ask yourself, why would they cut interest rates? Why would they do that? I mean, why? Because they're evil? Maybe a nation of renters. Okay, I get all that. But I mean, you know, any practical reason? There's no practical reason why they would cut interest rates in front of economic turmoil. Economic turmoil, they cut interest rates. I'm going to show you guys an article that actually is going to re-explain how like so much of the market keeps getting it wrong with the interest rates. But we're going to move on to our real estate stuff, guys. Now, I got a lot of data to show you guys. So we're going to go into a lot of data because, and then there was a comment too. Okay, let me throw this comment up real quick. Where's the comment? Oh, so this is Jason. So Jason's like, hoping rates go up and prices go down is wishful thinking. No, it's not. Prices are going down. Prices are going down. So hopefully you didn't miss that. So remember, there's two separate markets. There's what type of markets? There's new homes and used homes. Used homes existing. I mean, I'm sorry. If Jason, if you go right now and I'll throw it up for you, and actually it's probably updated right now. Oh my God, it's going to be updated here soon. I can't wait to go over that with you. Prices are going down, buddy. Prices are going down. And then also in a lot of markets are going down, but they're not going down everywhere. So there is no blanket statement. So wishful thinking, I don't know, man. I mean, to me, it's just like head in the sand. I don't know. I want to go over this here in a minute because cash flowing at $1 million. Oh my God, that's so hard. It's really hard to cash flow just off 400,000. Where's my comments at? All right, here we go. All right. Real estate section. Take a look at this first article right here, guys. This is from Housing Wire. This is not good. Spend into the end, Jeff. You know that. Spend into the end. If you guys are old enough, like me, I'm an old man, I feel like, and you went through the GFC, you will remember, you know exactly what I'm talking about when I say spend to the end, because it's exactly how things went down last time. But look at this from Housing Wire. And I do not like this because it's kind of like the same thing all over again. But proposal would allow Freddie Mac to acquire close-end second mortgage. The purpose would be to allow more homeowners to access their home equity without surrendering a favorable mortgage rate. So at first that sounds great, right? Unless people are getting their money to spend like, using this like a credit card, right? This is going to add to the inflation. You guys, if we haven't figured out that this is a spending society, the economy, the powers that be need us to spend money. If we were just united, we would be better off. We could crash the market ourselves right now. Right now, we could do that if we were uniting. And that's the great thing about community, but that's another subject, you guys. But they're continuing to make more and more programs to keep this whole thing propped up longer. The proposal published by the Federal Register recognizes that existing borrowers face limited options if they seek to access equity on their primary residence and if they purchase prior to 2022, particularly if they have a mortgage rate from a loan originated during the low rate environment of the COVID-19 pandemic. Traditional cash out refinances today may pose a significant financial burden as it requires a refinancing of the entire outstanding loan at a new and likely much higher interest rate. So only smaller second mortgage would be subject to the current market rate as the original terms of the first would remain intact. So let me read this last thing here, guys, real quick so you guys can see the nonsense here. The proposal activity is intended to provide homeowners with a cost-effective alternative. So that sounds great. I love cost-effective alternatives, but not in the front end of a recession when we should be saving our money. So instead of saving our money, here's another way to spend it. Here's another way to spend it. Here, buy now, pay later. Here's another way to spend it. I mean, geez, guys, what happened to us wanting to save our money to get ahead? That's exactly what Jeff did. And Jeff, stop bullying people. You better start explaining to people that you became a homeowner because you saved your money and you did the right thing and you went against the grain. You were not part of the rat race. You were not part of the sheep. The same thing with House Hacker. Same thing. Those guys are studs. Those aren't normal people. So when they go in and they say certain things, I worry sometimes that people are misunderstanding what they're saying because a lot of times they leave out that they're not normal. These are top 1% of people I'm talking about here. Top 1%. House Hacker and Jeff. Probably more than 1%. They're probably the top 0.5%. I mean, these guys, so there's wisdom there, but we get petty sometimes. We're human beings. Anyways, you guys, this is freaking horrible. Okay, now I'm gonna do one more thing now, okay? I'm gonna show you guys this. We got to be careful, guys. You know what? Actually, let me, this is what I'm going to do. I'm going to show you guys like this, okay? I want to show you guys as well. I'm not going to throw a blanket statement down. So I'm not going to disrespect you by throwing a blanket statement. I'm not going to disrespect myself by throwing a blanket statement down. There is partially a reason why prices are going up. Even though inventory is going up, demand is going down, affordability is going down, price cuts are in our historical records. The rich keep buying. And so when we calculate median sales price, understand that median sales price is, the way that's calculated, they pull all sales data. So in order to come up with median sales price, they have to have the $5 million homes in the equation. And so what I'm going to point out right now, guys, is the luxury real estate market's on fire. And I don't care about luxury. Personally, I'm not in the market to buy a $2 million house. I don't care. I say let the rich keep spending. I don't care. As long as like the affordable housing are just sitting there collecting dust. In most markets, not in Jeff's markets, not in Maryland. I know that. But in many markets, you guys, part of the reason, and I don't know how much, but part of the reason why we see median sales price go up on a nationwide average, I see you, Jeff, on a nationwide average, and you are funny, on a nationwide average, part of the reason is because the $1 million houses are selling and it's blowing up. Take a look at this article. Okay, this is kind of point here. The typical US, and then I'm going to show you guys data. Okay, so this is affecting median sales price. So don't just think home values are only going up, because they're not. And I keep trying to tell that to people. You got to go, and then even then you got to go into subdivision. How many times do I say subdivision? The typical US luxury home costs more than ever before. And I'm only going to read these bullet points. Luxury home prices in the first quarter of 2024 rose 9% in one quarter. Oh my God, year over year. That's twice as fast as non-luxury prices. Twice as fast. The rich are still spending like lunatics. Sales of luxury homes rose 2% compared to a 4% decline in sales for non-luxury homes. Luxury sales are this is insane to me, are outperforming, partially because elevated mortgage rates aren't a deterrent for many luxury buyers. As a record, 47% of luxury homes, you guys ready, were bought all cash. 47, the rich are still spending money and they're messing up, they're tainting the data. I don't know how much. I'm not saying that's the only reason prices look like they're going up. I'm not saying that. But I am saying that data does manipulate median sales price, which is, again, why we got to go comp analysis subdivision to get real value, okay? To get real value subdivision. But this is affecting it, guys. Look, and listen to this last bullet point. Total supply of luxury homes rose 13% year over year, the biggest increase on record. The new listings soared nearly 20%. Still, supply remains below pre-pandemic. Now, I'm going to show you this, okay? Take a look at this. Again, we're talking about the rich still buying. All right. Now, I've done several videos, but I wanted to do this during the live. This is regional sales price of only existing homes. We're taking out new homes. We already know new homes are going down in value. We want to why is existing home value appear to be going up? So that's the question I'm asking. Okay. Now look at this, guys. This is the change in sales from a year ago. So this is representing sales transactions. So this is sales transactions. And these are tiers. Okay. Each of those columns is a price point. Let me move my picture. Each of those columns is a price point. And what I want to point out, you guys, is homes that are 750 up are growing year over year. You see that? So if 750 to $1 million, that price point is up 5% year over year. But look at the biggest thing of all, guys. Look at the 1 million plus. 1 million plus is up 14%. So if the higher end houses, the $1 million plus houses, have a 14% growth, that's obviously skewing the numbers, especially when we look at this right here, okay, which is the other tiers right here, 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 and here. And we see loss on every other price tier. We see declining growth. So from 500 to 750, down 1.2. Now, the biggest group is 250 to 500,000. That's down 8.1%. 100 to 250 down 15.8, and obviously 0 to 100, that's down 21.9%. So again, you guys, I don't know how much. I don't know how to do the formula on that, but we know for sure. Again, we know for sure that the rich are still buying. And as a result, it's skewing the numbers. But not only with sales transactions, take a look at mortgage applications. So now we're going to look at another set of data, mortgage applications. Take a look at this, you guys. The same thing is happening here, only at a much more accelerated rate. For mortgage purchase applications for loan amounts greater than $1 million. So for loan amounts greater than $1 million, this is measuring year over year. We had a growth. Y'all see this? We had a growth of 63% in over $1 million loan purchase applications. We had a 64% increase. So we know people that are poor were priced out. A lot of people are priced out. People that are rich, they don't care. 47% cash transactions. Are you freaking joking me? So again, I say let them burn their money. Let the rich burn their money. Especially if we have negative equity decline, let them waste their money and let it evaporate. I don't care if people that are buying multi-million-dollar houses, they have different problems than us. But isn't that intriguing? And look at this. $900,000 to $1 million loan amounts. The growth is 47.6%. That's insane. 800 to 900, 22%. 700 to 800, 11%. And then it goes into single digits for anything $700,000 and below. So I think we could fairly say, you guys, and again, I don't want to make a blanket statement. I don't know how much it's impacting. So I don't want to say that I act like I know everything, because I don't know everything. But I do know that that is skewing median sales price. And that's a fact. So I know that. So we'll keep an eye on that, guys. Now, let's see here. I got more questions. We're going back into trivia. Okay, and then I'm going to show you guys MLS. So I want to go into trivia, and I want to show you guys MLS. But I have a next question. Realtors, get ready. Realtors, get ready. This is a credit question. I want a realtor to get this right. Okay, this is a credit question, and it's pertaining to credit cards. What utilization ratio should you never exceed? What is the maximum percentage of utilization ratio? You never want to exceed what percent of credit card utilization ratio? What percent do you not want to exceed? If you exceed it, dang, you guys are good. I love you guys. I love you guys. I need to know you guys are learning. I need to know that. That's right, 30%. If you guys are under 30% utilization ratio, generally that trade line will give you a credit score increase. If you're over 30%, generally that trade line will give you a credit score decrease. And then Wick Hawks, let us know. Beef jerky hack. That's right, buddy. Yes. Yes, the beef. If you guys don't know what the beef jerky hack is, basically, you guys, I had like a 400 credit score. I got my credit score like up 200 points from buying beef jerky. If you want to know how I did that, just join the home buying course that I made, because I explain exactly the beef jerky hack. I love that. Man, I'm proud of you guys. Love you guys. But anyways, yes, you never want to exceed 30%. And what's up with the realtors? What's up with the realtors? One more, and then I'm going to go. Okay, we'll jump into MLS. I have one more question. This pisses me. This upsets me. One of the biggest frustrations I have in real estate. Okay, realtors, you guys, if I swear, realtors, if y'all don't get this right, swear if y'all don't get this right, you better answer this before my RIM members, because I never talk about it. Okay. Why does appraisal value differ on the same property? So the same property, why can you have two different appraisal values? Same property can have two or more different appraisal values. Why? Why, you guys? Why do the appraisal values adjust so much on the same property? No, I said no, not necessarily. It's not necessarily comps, because I said same property. So you can use the same comps. There it is. 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 Boom. Dang, man, you guys are. Les, I love you, brother. I love you. Yes, because remember, you guys, appraisals are an opinion, and sometimes opinions stink like poo-poo. Some opinions are horrible, and they mess everything up. So don't make mad the real. If you're a realtor, don't upset the appraiser, because remember, you guys, it's an opinion. People get emotional. Emotions affect opinions. But remember that. And that's what I hate. I hate it. I hate the fact that appraisals are opinions, because they vary so wildly. Dude, Les, I love you, dude. That is my opinion. You're right. That is my, well, actually, that's not my, so Ruben, it's not my opinion. And that's a fact. Appraisals are an opinion, the comparable market approach anyways. All right, guys, good job, man. So was that 6-0 REM versus realtors? You guys, it's 6 zeros. The realtors are going to get one. Okay. I'm going to make sure. Take a look at this, guys. Now, remember, I just went over a whole bunch of value stuff. We look at median, it's going down when we add new homes. I mean, value, right? But the thing is, guys, it's all macro. It's all complete waste of time. Okay. For the sake of argument, you got to do your subdivision analysis. I'm going to give you guys an example of what it looks like. I'm not going to do the analysis, but I'm going to give you an example. So this is MLS. Okay. So you guys see this? This is MLS. This is what I have been saying for so long, that the public needs access. Realtors hate that I say that, by the way. You guys need access to if you guys get access to this, I will train you all. I'll train you all for free on how to use this for free, and I will make you guys absolute stud champion buyers, but I can't do it if you don't have access to this. This is the MLS. I'm going to zoom in. Okay, first of all, look at every city is different. Even if we look at individual cities, it's still macro. So if I only want to look at Huffman, there's 91 homes for sale. If I want to analyze Huffman, still macro. Still macro. You got to go hyper duper local. So let me zoom into Kingwood. Okay. And you see all these houses. But remember, you guys, every one of these is in a subdivision. You see this that I'm circling as a subdivision. Look how much different this subdivision is. This is a subdivision. So any of these houses here that I'm interested in, I would do a subdivision on this. I would do an analysis in the subdivision. Now, likewise, any of these houses, you see that subdivision I'm circling? That's a subdivision. It's called King Manor. So I would do the analysis on King Manor. I would just be doing simple, basic math. Now, again, let me show you. So all we want to look at is the subdivision. So I'll put in King's Manor as an example. Okay, and I want to only look at sold properties. Sold properties are comps. We always hear about comps. We need 3 comps for an appraisal. So all I would do is I would look over the last year. This is just a quick, I'll go back 3 years. I go back to 2021 and 2022. 2020, FYI. But anyways, this says that 39 homes sold in that subdivision over the last year. So they'll show you the results. See? Here's all the results right here. And all we got to do is add all this data together. We select all the data. This is so easy. Select all the data. You go to stats, depending on if you have the matrix, and you go to tabular, and it does it for you. Now, if you don't have access to this, you can use Zillow, and you can add it manually. You add it all manually, and then you divide by the number of comps. So I know that the average home sold for $130 a square foot in Kings Manor. Y'all follow? So if I have a property listed in Kings Manor under 130, could be a good deal. Y'all want to see? Let's see if we have any properties listed in Kings Manor for 130 or less. All right. So we're going to go back here. I'm going to go to Kings Manor. Now that we have that, let's see if we can find anything. This is all live data. If I didn't have this, man, I would be such a mess. Like, thank God I have this. All right. So we got 5 comps. Let's see the results. So 5 comps. Look at this. Look at this, guys. Okay. So we have 2 comps under 130. Okay. And we have 1 comp way under 130. Look at that. That one's got about $27 per square foot wedge. Y'all hear me on that? That's got about $60,000 in wedge. So that's how you play this game. And that's why I'm saying, like, don't just buy a house. Like, help America. And if you have to buy a house, you better make sure to drive the prices down, not up. Now, obviously, you want to look at the condition of the house, right? Normally, it's like crappy condition, right? I mean, but look at this house, guys. This has got wedge. I mean, it's outdated, but this is how you work it. I can find deals, not great, but I can find deals right now. I mean, I say this all the time, man, you know, please guys, I'm not just gonna say, just do what I say, but anyways, let's move on to the next thing, guys. Let's see if this updated. This is sales. Oh my God, I'm nervous. I have to refresh this. This data should have come out already this morning. This is median sales price for new homes. Right now, before it's come out, we're sitting barely above 400,000. Okay. I want this to be under 400. Now, before I refresh this, I hope values go down, but I suspect it's possible that they go up because remember this time last year, people weren't really buying. They were freaked out. Oh my gosh. I see the super chats. I'm going to get to those super chats. I really love you guys. Thank you so much for that. So it may go down because remember this time last year, people were freaked out because of the bank runs. And then obviously as we got into summer, people just spent money like crazy. So let's see. So right now it's 400,500. Let's refresh. Oh my God, look at that. So it did go up and it went up a lot. Look at that. Okay. So that's as I expected. Okay, that went up a substantial amount. So right now, you guys, it went from 406,500 to 437,700. It's going to be interesting to see this data once it updates. But anyways, so that's off from about 500,000. We got work to do, unfortunately. That's a pretty massive increase right there in February. You see right here from February to March wasn't really an increase. You see that? Now, remember, you guys, most of the sales and transactions happen around spring. So this is a massive tick up. I suspect, again, that's going to go down, but we have to get through the BT, Big Term Funding Program. That's up. Let's take a look, guys, at supply right now. Before I refresh, we're at 8.4 months. We need sustained 6 months. We've been sustained 6 months. Let's see here. Since about September. No, sustained is right here. February of 2022. So we've been at 6 months or more for 2 years and 2 months. Probably a big reason why prices are going down with new homes. Let's see what it's updated to. It's at 8.4 right now. Dang, that was a huge increase. 8.4 to 8.3. So it's about the same. So you see 8.3 right there. Very interesting stuff there. Very, very interesting stuff there. What I'm going to do, guys, is I'm going to play our next video, which is going to be on luxury real estate. Again, just to kind of reaffirm what I'm saying, with prices, higher tiers selling a lot more than the lower tier, which is affecting median sales price somewhat. I'm really looking forward to looking at the size of houses as well once that data comes out for new homes. I mean, geez, I did not expect it to be up $25,000. I'll tell you that in 1 month. That hit me by surprise. All right, guys. So our first video on luxury. I want to play this right now. 5115. All right. Let me know that the audio is okay. Pretty please. Actually, I can't do that.
Despite those high rates, one key part of the housing market is booming, and one you wouldn't expect. Our Robert Frank is here with some of those details. Morning, Robert.
Or maybe you would expect it. Real estate sales falling 4% nationwide in the first quarter, but luxury real estate saw the biggest increase in 3 years. That's according to Redfin. The tale of two markets is being driven by rates and supply. Mortgage rates above 7% have put most homes out of reach for most buyers, but affluent and wealthy buyers, they get to pay all cash. About half of all luxury homes were bought with all cash in the first quarter. That's the highest in at least a decade. In Manhattan, cash deals hit a record 68%. All that cash is, of course, pushing up prices. Luxury home prices went up 9% in the quarter. That's twice as fast as the broader market. Higher prices also drawing in more buyers. The number of luxury homes for sale jumped 13% in the quarter. That compares to a 3% decline for the rest of the housing market. So the big difference here is inventory. The market with the fastest luxury price growth was Providence, Rhode Island, followed by Virginia Beach. Seattle posted the strongest sales growth for luxury homes, followed by Austin. So, it's really the rates and the inventory where, because people at the top can buy and sell for all cash, they have more options, and they're not going from a 2.5% to a 7% mortgage because they're going cash to cash.
Okay, so again, we looked at 4 sets of data saying that most of the luxury is blowing up, but still, there's still inflation. There's still people buying. I know that for sure. I'm in Houston. There's still people buying. That's a fact. But again, the growth is at the higher scale. Hope you guys understand that. What we're going to do now, and at the end of this, guys, I'm going to throw up those super chats. I really appreciate that. I just want to be steady real quick. Now, let's go into recession and liquidity indicators real quick, and then we'll kind of try to get you guys out of here. But take a look, guys. Here is our recession and liquidity indicators. This is the 10 and the 2. We've been inverted for over 2 years now. This is a huge indicator of recession. We're still 30. We've basically been frozen here since like the beginning of the year, pretty much. So we've basically been frozen here basically since February. We've been stuck. So the market's like, we don't know what's going to happen next, but either way, we're 35 basis points inverted. Again, huge indicator of recession. Also feeding the recession and inflation is the deficit spending. We're sitting year to date. Jeff, this is insane. We're sitting year to date at 1 T. Let's just say T, not Travis, trillion. T, 1 T, $1 trillion year to date. It's not even the end of the year. Not even the end of the year. $1 trillion feeding the recession, propping the market up, whatever. But also take a look at this. This is also feeding the recession. Government jobs. Government jobs. So government jobs feeding recession, not private jobs. And I just wanted to point out where. Let me show you guys September. All right. So from September of 2022 to March, okay? We've had, if you look from this, where I'm right here, from right here to current, 1 million. So from September 2022 to now, 1 million, which is a year and a half. We've had 1 freaking million government jobs or new government jobs, new employees added. So again, not healthy. And look at the trajectory. That trajectory is massive. So that's one thing, guys. That's feeding obviously recession. That's why I'm saying that. But here's another thing. This is huge. For all the people that went through the GFC, y'all know what I'm talking about. If you didn't go through the GFC, maybe you know what I'm talking about, but you don't feel me. If you went through GFC, you feel what I'm saying. Different. This is transition into serious delinquency. This is a report by Freddie Mac. I've done a video on this as well. Hopefully I'll release that here soon. But this is from Freddie Mac. Came out with a report. This is consumer debt that is going into serious delinquency. Basically, the show is over. And first of all, I want to point out the red line because the red line is also propping up the economy. So the red line is school loans. Anyone forget about the school loans? We're being propped up because people are spending money that they would normally be spending on their school loans. Look at the freaking delinquent. They're not even paying their school loans yet. Remember, they put another 1 year clause that you couldn't be late on your credit. You guys don't forget, school loans is also feeding a recession because there's no payments. They've turned it off like a light switch. But look at the green line. That's credit cards. Look at that green line. When over the last 20 years? No, let's say 15 years. When in the last 15 years have we had that trajectory? Never. We haven't had that happen. In fact, the only time that's happened was during the GFC. In the last 20 years. So in the last 20 years, some of you may not even be that old. For the last 20 years, the only time we've had that type of trajectory, because this is signaling to us consumers are not doing okay. It's signaling to us they're not doing okay in the most smallest form of debt, credit card. It's signaling something's wrong, but you can choose not to look at that. That's fine. Depending on your market, you may work for you. But you guys, the trajectory is freaking nuts. Last time we had that trajectory, again, right before we went into recession during the GFC. In fact, it's higher. This is when we went into recession, right where my mouse is. So it looks like it's about the same, okay? But also, same thing with autos. Auto serious delinquencies are at the same rate as when is actually higher. It's higher. So auto loan delinquencies are higher than what we had going into the GFC. Well, then why aren't prices going down, right? But look at mortgages. Mortgages is this line right here. Mortgages are very low. Why are they low? Well, people have equity. That's a huge reason. That's a massive reason. And moratoriums. That's also a massive reason. They pulled a lot of that benefit forward, though. But again, look at the trajectory. Still low. It is. It is low, according to this data. But the trajectory is going up. And that's what I'm saying. And again, you go back. When has the trajectory gone up? When is the last time that trajectory for mortgage delinquencies went up? When was the last time that happened? The last time that happened was the GFC. So over the last 20 years, we did not have the trajectory going that way. And that's why I'm saying pay attention. It's going a lot slower than a lot of us thought. And that is messing with our patience. But don't think for a second that we aren't on a road of turbulence. We are on a road of turbulence, and we can see that here. And when we really stop to think about what's going on, yeah, maybe we should be cautious. Let me show you another thing. Jeff M. This is my debate with Jeff M. And me and Jeff M, we respect each other. We love each other. And if you guys don't agree with our community, you can love and respect us too. And we can have a conversation and we can grow together. We don't have to be all petty and crazy like so many of these millionaires are. Why? It seems like the more money you make, the more of a turd you are. A miserable turd. Isn't you guys disagree with me? Literally, look in the comment section. It's like all investors. You guys are a bunch of turds. This channel's not for you. Kick rocks. You're the reason why we have this problem. At least part of it. And I hope you take that to heart. I know you won't because you're so petty. But anyways, personal savings rate. Now, Jeff, during the 70s and 80s, where home prices normalized, we had a savings rate of 12-ish%. Right now, we have no savings rate, and we have a massive inflation crushing us. We have a 3.6% savings rate. That's dirty, you guys. That's dirty bad. And not only that, real wages are down. Now, Jeff thinks, and I always use Jeff because, again, because I really respect his opinion, and he's like the opposite opinion in some things, but we respect each other so we can talk about it. But here's real median income. Jeff is saying by 2030, real median income is going to go up. So far, Jeff, it's been going down since 2019. Real income is adjusted for inflation. So when we adjust for inflation, it's going down. So let's go back, guys. When was the last time we had this trajectory? When was the last time we had trajectory of real median household income going down? The last time we had real median household going down, they told us this time is different and prices of homes never go down. The last time we had this trajectory of real median household income go down, they were telling us this time is different and home prices never go down. That's the last time this has happened at that trajectory right here, 2007. So 2007, and it took till 2012 for wages to start going up again. So this is what Jeff is expecting. This increase is what he's expecting to happen in 2030. It hasn't happened yet, though, and people are struggling on the bottom. Now, here's the liquidity. Here's liquidity. Here's the reverse repo market. My God, guys. The reverse repo market's nuts. I was hoping by the end of next month this would be gone, but that's not looking like that's going to happen. We have stayed at a plateau since about March. It's been stuck, dude. Look at the reverse repo market. This is in a long step. So you guys see there's a step right here and then down and then maybe a little step here and then down. And like we're on this huge step where the money is just staying there. This is causing inflation. This is like the, suspension system. Keep your eyes on that, guys. There's still a lot of money there. Here's the liabilities in the Treasury General account. More inflation, just more inflation. I mean, they're selling and then they're selling debt and taking the money and spending it. I mean, they're keeping it. The Treasury is keeping it at about 700 to 800 billion, and they're spending it. This is like the government spending account. Very high. That means there's still a lot of money out there. Still a lot of money out there. Moving on. This is what you're looking at is either QE or QT. Okay, quantitative tightening or quantitative easing. This is so quantitative tightening, quantitative easing is like the Fed buying or selling assets. Quantitative easing, buying assets. Quantitative tightening. What's up, man? Selling aspects. Selling. Jason, if you guys need editing, go to this man. This guy helps me with my editing, except my Metro Towards editing. I do all that. But they are selling mortgage-backed securities. So this is great, but look how slow. I mean, if you don't think that the Fed can manipulate the market, I don't see how you could think that. They can absolutely manipulate the market, guys. So anyways, let's go into our next thing. I'm sorry, I feel like I'm rambling, you guys. This is a little bit longer of a live. I'll have everything chaptered as always. We're going to go into our last video, and then I'm going to throw up some super chats. Our last video is a little bit scary, and our last video is going to go into the fact that they said they're not going to do any more bailouts and that the banks are now going to start bailing in. And the reason I want you guys to listen to this is because don't take these things lightly. Like diversify, maybe I'm not a financial advisor, but diversify your money. You know what I'm talking about? Don't just have like $5 million in a bank because you're only insured for $250,000. All right, here's the next video.
It's my money. I'm allowed to withdraw from my own bank account. Yeah, so you said that what's the maximum limit you can give a withdrawal to a customer? It's $3,000 on the date. You've already mentioned that multiple times. Yeah, not today. Why not today?
Wow, folks, that's a video going viral TikTok. That's a bank in Canada, the bank in Canada refusing to give a customer money. I mean, it was his money. And, we've talked a lot on this show and for a while now with respect to inflation in the market, but what doesn't get enough attention is the social impact. There's a direct correlation, for instance, with higher inflation and homicide rates. And of course, we continue to talk about this big spike in the so-called Big Mac indicator. By the way, that's also minimum wage. There was a time when we used to worry about this stuff. This is the cover of Time magazine, March 13th, 1972. It says, "Is the U.S. going broke?" Now, the article begins with the statement, "Can a nation with $1 trillion economy be running out of money? By most measures of private wealth, the U.S. is the richest country, but in terms of its ability to pay for the public services, healthcare, education, welfare, garbage pickup, pollution control, police, fire protection that make the life of its citizens pleasant or at least tolerable, or in some cases even possible, the country seems almost to be going broke." I want to bring in now Walzer Wealth Management President Rebecca Walzer. Rebecca, you can say that now multiplied by many times, but we just don't seem to care. At least back then, someone was paying attention and someone did care.
That Canadian clip is so scary because that really could happen in America. The Federal Reserve has already talked about potentially a bail-in. They will not bail the banks out again, Charles. If anything happens, money could be frozen and clients will be locked out.
Do you believe that, though?
No, I don't believe that would happen.
No, do you believe they won't bail the banks out?
two things. You've got the Federal Reserve, which really is a bank for the wealthy.
Right.
I mean, it's a bank for the banks and a banks for the wealthy. That's who they work for.
I like
they
that.
don't work for the U.S. for citizens. It's time people understood that.
I'm so glad you said this, because so many people think that because we're the world reserve currency that we have to bail out the dollar, that we won't let our system collapse. What they don't understand is what the BRICS nations are doing to basically do cross-border payment transactions in local currencies without a reserve alternative to the dollar. So yes, I believe with the amount of deficits that we're running, that we just seem to carte blanche. We're not in a war right now directly. We're not in a pandemic, and yet we're still getting a $7.3 trillion budget proposal from this administration. I think the rest of the world is saying America has taken modern monetary theory way too far.
And of course, you've been talking about gold for a long time. It's paying off. No,
Yes.
listen, this is why you've been positioning your clients.
Absolutely.
Central banks have also been positioning there.
Yeah, that's what I'm saying.
And the big spike came with the invasion, right?
Right.
Russia's invasion of Ukraine. So this is not just inflation. This is sort of an indictment on the geopolitics. And I think
Yes.
the ability of America to come to the rescue of the rest of the world.
Yeah, I mean, if you kick someone out of the SWIFT system and say you're going to confiscate their $300 billion in US Forex holdings, that's a problem. Obviously, that wasn't done.
Right.
But Charles, that scares a lot of countries, and they basically are buying other things besides the dollar.
So then where do we go from here?
I mean, I am bracing for really global upheaval, macroeconomic disruption, global upheaval. And if we have a World War III or an escalation, that certainly will bring it all the more faster.
I mean, the spike in Google searches for World War III is through the roof.
Exactly.
You know? And this periodically happens. Sometimes people get excited and say, oh, it's no big deal. But at some point, it is a big deal, particularly if it's on the minds of people, because people react to the way they're feeling.
Well, it's also that we've had ongoing conflict that involves a global superpower, Russia, since 2022. And people are uneasy about that. That has not completed yet. Now we've got the Middle East popping off, too. You've got China, Taiwan, tensions going. And with what Xi Jinping is always saying, Taiwan is a part of China. You know, there's a lot of geopolitical problems right now, on top of the economic problems, on top of no one seeming to care in the United States how much money we have to constantly keep printing. Charles, we could go no bid on a treasury auction. That will really tell us something.
Wow. A lot of folks are saying it will have to be the bond market that gets our minds right. So I got 30 seconds. If they're not in gold, they should still be buying?
Well, this is definitely not the top end. I don't expect it to keep going through the moon. I think we'll have some retrenchment, but it will continue to go up as these global
That's what you'll be able to sleep at night with, though.
Yeah, absolutely.
All right.
Brutal. Yeah, so just be careful with y'all's money. All right, so let me see what else. Oh yeah, all right. Let me throw some stuff here, guys. I want to do some Q&A stuff. There were some pretty good comments, and also big shout out to some of the super chats. And also I want to end by I want to do the Dallas video this evening. You guys catch the Dallas video. So I have the intro done. I already sent it to the Discord group, so I'll play that. But real quick, let me just give some shout outs. BRN, I really appreciate you. Teacher Travis used the $5 to buy yourself an Apple in 2024. Brother, you know that Apple is now $6.50, man. I'm going to buy half an Apple, maybe some Apple squares. But no, BRN, I appreciate that, man. That means a lot to me, as a content creator. Thank you, brother, but you don't have to do that. I would prefer you saved your money. But thank you, my man. Becky, welcome. Welcome, Becky, as a member. I appreciate you. All right, now take a look at this. This is from House Hacker. Welcome back, House Hacker. I haven't seen you in a while. House Hacker is in my opinion, I don't know him, just from the comment sections, we've talked back and forth. House Hacker, I would consider a real estate investor. And I know I've just slammed investors. You guys are the problem, but I'm just generalizing. There are some investors that are actually very smart that will help you. But I'm just saying most investors, huge arrogance, just FOMO, just spitting all over. They just love themselves, man. They it's just disgusting. Miserable. Most of the people are miserable. Anyways, so just understand, House Hacker, did the right things, stayed patient, and made a good decision. He purchased back in 2022, and he was able to get it to cash flow. Let me read the comment. I just lost on a bidding war 2 days ago. I placed an offer on a duplex at asking price, $775K, lost to $925K. I don't know if that means it was under market or not. So this would go into the fact that if someone purchased that for $925K, again, the higher end of the market, but he's in San Diego, so that's probably not the highest end. I'm like you, can have it. And good luck cash flowing on that one. So the reason I brought this up is not to really talk about House Hacker. It's to talk about cash flow. What I'm noticing in my market here in Texas, guys, now I've put, if you're going to have cash flow, it's hard to cash flow in my market at anything above 400,000. The property taxes out here are crazy. So it's almost impossible to cash flow at a certain point, depending on the property. Jason, hope Hoping rates go up and prices go down. Oh yeah, we already talked about this. Wishful thinking. Obviously, we have data, multiple data sets now. Here we go. Okay, so another realtor. I don't know why I threw that other comment. A realtor named House, Adam House. Howdy, y'all. Y'all are beautiful. Appreciate you, Adam. Thank you for the support, man. I was hoping you guys would get one of those questions right. I mean, this is another clean sweep by Real Estate Mindset. Another clean sweep. Dean, love you, man. I see Dean all the time. He's in our Discord. With how much you paid in taxes, have you considered living in Puerto Rico 183 days out of the year so you can pay 4% Fed income? No, I haven't considered that, Dean, because I still believe. I mean, I live in Texas. I still consider myself a patriot. You know, I tithe my money. I help my community out. I'm doing things for free to help my community. I'm still in America. I don't want to leave America, but I like what you just said about that 4% Fed and 0% capital. I still have faith, man. Like, I haven't given up on our country, even though there's just really bad things going on. But Dean, I really appreciate that support, man. Got another one right here, guys, from a realtor named House. I'm offering a free doc review in Illinois and Indiana, sellers and buyers. If you guys want any doc review, I'm not sure what that means, brother. I appreciate the support. Obviously, he has a channel. You guys can click his channel. Go take a look at that. Thank you for the support, brother. Jack. Okay, Jack, $10, man. You know, I'm gonna get 2 apples. Thank you, Jack. First of all, from the bottom of my heart for your support. It makes me, you know, it's not the dollar amount. You guys don't have to give me any, but man, I'm out here working hard, and sometimes I'm working so hard, I don't know how I'm doing, right? So thank you, guys. Debt market meltdown is first, then stocks collapse, then commodities, emergency rate cuts soon. Yes, the rate cuts are going to be an emergency rate cut, right? It has to be an emergency. I agree with that so far. Unemployment will skyrocket it. Yes, remember, it's through recession when these things get bad, not before recession, right? Through the recession. And the Fed will buy back the debt cheap. I hope not. That would be suck. Deflation, depression, and stagflation. So this is a crazy story that's not done being untold. And I think that that's just really good time to be cautious out there, guys. I mean, you know, very good points. Thank you for that. Last comment here, you guys. Travis, do you think luxury sales are up in luxury markets because some rich are getting scared of this market and finally decide to sell to the rich who have been waiting for these properties? I don't know, man. I don't know. It's certainly possible, right? I mean, it's probable what you're saying, but I don't know that for sure. I'm not really in a luxury market. I'm in Houston. I just don't have enough experience to talk about luxury, to be honest with you. But it's certainly a possibility. I would think, though, that's definitely a possibility. That could be a good possibility. But like, again, like, I think what we really need, brother, is like, we sadly need the unemployment, the labor market to soften and things like that. Oh my gosh. Dragon Slayer, $20, man. Dang, dude. Appreciate that, Dragon Slayer. To the Apple Fund. So you know what? I'm gonna get a case of apples, probably some what's a good apple? I don't know, the green ones. I'm gonna get some green apples. Really appreciate you guys' support. Really helps me going. These lives are really hard. It takes me about 3 hours to prepare. I do this. Oh my gosh. I do this, guys, because Madeline, I do this, guys, for you. I want to get back to the community. I want to know that I'm helping people. I want to know that by people listening to me, you're growing. And even if I'm wrong about a collapse, you guys should still be winners, because I'm telling you what to do as you're waiting, right? And also, if you find a house, go buy it. There's my long, list of things that you should have, though. I just really appreciate you guys, Dragon. Really appreciate that. I have another super chat here from Madeline Doyle. 237 Boulevard, Unit 6, Delulu. I'm not sure what this means. Let me go back to the live comments here. I'm not 100% sure. I think that maybe we do a market analysis there. I think that's what you're asking for. Market analysis in Delulu. I'm not sure. I definitely appreciate that. So anyways, guys, look out for that Dallas video. Let me know if you guys like that. Those videos are a lot harder to make, but either way, hopefully I'll see you Friday. It may be Saturday. Hope you guys are doing well. Don't forget to love some people. We don't need to buy a house to be good people. We don't need to buy a house to raise a family. You just need to have a good heart. You need to have a good, be a good person. Love some people. I understand you're frustrated. I understand you're impatient, but so am I. And I'm still smiling and I'm still trying to help people. And I got to tell you, by doing that, it makes my life so much better. I don't want clout. When I turn the camera off, I want to be left alone. I don't want any fame. What I really want, what I'm really selling here is you. on you. Be independent thinkers. I love you guys so much, but just be independent thinkers and grow. Okay, that's why I'm here. Anyways, guys, there's Charlton. What's up, Charlton? I'll see you on Zach's probably. Zach's on tonight. I think Zach's on tonight. And Red Delicious Apples. I appreciate it. There's Vegas. Let me just shout out Vegas. Love you. Mars, Charlton, Jeff, all these people. There's my girl Nikki. Just I am blessed. We are blessed. We got realtors in here. I mean, everyone's doing good. Where's Johnny at? I don't see Johnny. Anyways, guys, I'm going to get out of here. It is absolutely bonkers. And appreciate you guys. If you are out there investing in real estate, you guys already know that I do wish you luck. And I hope and I pray literally daily before I even did this, I prayed, I hope you win.